Hello, everybody, and thank you for joining us again for our weekly market update call on this Monday, August the 3rd, 2020. I'm Jay Gragnani here. Joining me this week is Steve Raymond, and hard to believe, Steve, geez, that we're talking about now moving into the month of August. The first 2 months of summer are behind us, June and July. We enter August now, and historically, the market during the summer months has been pretty lackluster historically over the years. But, as we have seen here now over the past few months, that the market has certainly continued to buck a lot of historical trends and a lot of historical averages in many different fronts. And, the month of July certainly was no different as the month of July closed out on a positive note. And so this week, what we wanted to touch on is a couple of things. One, just looking back at the month of July and seeing what areas shined in terms of performance during the month, and also what that has done from a technical perspective to indicators as well as a number of different chart levels. Also, one of the things that we touched on last week that we wanted to bring back to light was the U.S. dollar. We've seen a notable decline in the U.S. dollar, by now 10%, so officially falling into what we would consider to be a falling dollar environment, and talk about the trends and the impacts that has on markets across the globe. And then also updates on fund score activity in terms of money market percentile ranks, but then also what's moving underneath the surface, what areas have seen the most improvement over time, over the course of really the past month or for a few weeks. And so with that said, if we go back and just kind of look on the surface in terms of just pure performance, the month of July, the S&P 500 was up over 5%, which is a very strong month in terms of performance for the market in the month of July. But there were lots of other areas out there that performed well, and probably the biggest names out there were the precious metal space, silver and gold, right up there at the top of the list with SLV, which is silver, up over 30%, and GLD up over 10% during the month. And those are two ETFs that represent physical exposure to the metal. So those two ETFs, there are physical bars of gold or physical silver that back each of those ETFs respectively. And so for those that are looking to gain exposure to commodities, to precious metals in particular, there's a couple different ways that ETFs and funds have the ability to gain exposure to that. One is by physically backing them with bars like GLD and SLV. Others, they can do so by exposure through futures contracts. So those are the two primary ways that commodity funds will gain exposure to the metals as well as other commodities out there. But just know that going into it, there's different tax treatments when it comes to owning an ETF that might hold futures contracts. So those will typically generate K-1 statements. So just make sure, if you're looking to gain exposure to those metals, understanding how that they're actually getting exposure is important. Whereas something like an SLV and GLD, they're not going to provide K-1 statements as a result of the physical backing, but their tax treatment is still slightly different. So with that said, in terms of other areas that performed well, the momentum factor had another good month, up almost 9%. PDP was up almost 9%, 14% on the year. And then emerging markets also, emerging markets has really come on here of late, still down on the year, but it was up over 8% in the month of July. And so, emerging markets is an area that has recently come to light, has shown some notable score improvement, notable trend improvement across a number of different areas of emerging markets. So that's still an area certainly worth watching and considering within portfolios. The other end of the spectrum in terms of July, it's interesting as well as emerging markets did, the developed ex-US markets, the EFA index, up only 2%, so lagging a lot of other areas of US equities. As a matter of fact, every area, with the exception of energy as a broad sector, which energy was down almost 5%, had re-entered some negative trends on a number of energy charts, and so energy, after seeing a pretty notable rally, has seemingly returned back to negative trends here over the course of the past few weeks. So with that said, the S&P 500 in and of itself, we mentioned the strong returns, Steve, on the S&P 500, and we see Today, another X added at 32.80 as a result of the market opening, strong opening so far today on Monday. And, assuming things hold, the S&P chart is continuing to close in on that 3,300 level, Steve.
Yeah, in fact, we think that, striking a 400, level, high, the high 33 level is, it seems where the trend is, and as we mentioned over the weeks, kind of the trailing alert to alert you for as far as the investor kind of range is still at that 3,100 level, back down a few clicks. I think traders will want something more sensitive. If you look at more sensitive charts or futures charts, 3,180 looks like a good trader's alert in case the market pulled back through those two zones. But we have a very good uptrend here, a very powerful uptrend, and we assume it will continue. As you know, when things feel good, when things feel great, sometimes there's a yank down. But what we've noticed since March is that the market's been holding a pretty solid trend line, and most of the pullbacks are picked up pretty quickly by traders and investors coming back in to support the market on those down days. But what we've seen over the course of the week as we closed out the month, kind of got into the August time frame, which coincidentally is the next part of that seasonal quarter. So the seasonal quarter of August is part of that summer, second part of that summer time frame. And as you mentioned, JG, historically, this is kind of your weakest part of the seasonal cycles in front of us here. In other words, August and November historically contains a fair amount of lackluster or negative performances by the core market. But as you also mentioned, we're bucking some of those historic adages. But it's always good to keep it in mind that we're entering into the weaker part of the seasonal cycle. The market still looks good, very positive in trend, and so forth. But we'll keep an eye on things, and that's why you look into it to make sure that we're on course. Back to you, JG.
Yeah, and one of the developments that we have seen as it relates to the S&P 500 unfold here, closing out the month of July, that we haven't seen throughout this recovery has been a positive monthly momentum reading. And so monthly momentum is just a 1 month versus a 5-month moving average. And when the 1 month crosses above, then the monthly momentum turns positive. And what we saw, as is the case and was the case with a lot of moving average analysis out there, is that the shorter term moving averages got so far below the longer term moving averages as there was a big spread. You go back to April time period, and the strength here, the recent strength has seen that monthly momentum turn back to being positive. And what we have seen historically is that, on average, when those momentums change either to the positive or to the negative side, they tend to stay there for, a number of periods. On average is about 7 months that it tends to stay positive or negative. And so a recent move here to positive monthly momentum for the S&P 500 would just be viewed as another feather in the cap, if you will, another positive development that we can kind of stack on the side of pros for the market and the S&P 500 specifically. But that is certainly something, something of note, something that is worth taking into account there. As it relates to other areas, I mean, the S&P 500 index funds, the core market has seen a strong reading. When you look, Steve, at the macro view, has been up there for quite some time with an average score of 4.5. And so lots of other areas have seen improvement as well, but that has really been one of the leadership trends out there.
Yeah, it's kind of been a consistent theme for years, and quite frankly, the core of the market, should be a good percentile ranker, to use that phrase. Most of the historic time frames, you could say 72% of chronological history has the core market as a dominant player, and that's good news. And of course, that's where we are now, and that provides, some sort of a stability, certainly for the global markets, but in particular the U.S. markets. I will point out that the percentile rank of the core dipped a little bit near 80 in July on one of those sell-offs, and is spiked back up as we crossed into August, about 5 percentile rank. So we're heading up to this area where the core has been kind of running on average for a couple months, which is near this 86th percentile. And sometimes it gets, backed off from there or whatnot. But that seems to be the theme, which is to say the market's core is very confident. The market's core is in good shape on a relative strength basis versus all asset classes around the world. The money market percentile rank is still in the bottom quartile, settled out in this 16th percentile area. That means that 15 or so percent of the world's asset classes trade below the score of money market, meaning not functioning as well as cash. However, near 85% of the world's asset classes are functioning normally, offering something for the risk you're taking, and so we find that quite acceptable, for the risk on metric. Some would say that the money market percentile rank, often historically does dip below 10 and dip below 5 and cruise down at very low rank levels. This is true. However, the money market typically will travel in that bottom quartile in different ranges. So again, a restatement, this is not a blue sky area that the money market is in. It's not low enough to say this is very calm and very blue sky. But I think with the money market being at the 16th percentile and the VIX being at the 24th the 24 reading, that gives you kind of an idea. That there's still some expected moves here, of 2.5. And then sometimes I take a daily, prognostication of market movement, times it by 2. So, 5% moves. This kind of thing, we're still in that boat. I don't think that's changed, but the reading of the core and the money market percentile rank do still suggest an offensive position, risk-on mentality concerning all kinds of asset classes. Certainly, equity comes to mind for most people, but there's all kind of asset classes out there, including some commodity-based, and certainly so. Another notable mention here in the macro asset classes is still some significant upticks in what I would call the global and international diversified markets. This would mean, funds that are tagged non-U.S. as well as funds that are tagged global, meaning they include some non-U.S. and U.S. combined. This whole broad area is still upticking and still putting up improvement, as well as the fact that they already have acceptable scores. So I think that's kind of, as we mentioned, some weeks ago, the newer entry into solid citizenship in the world is very much the international, the global, the non-U.S. Type of improvements that we've been seeing. And JG, I just think this is kind of one of those phenomenal improvements that is worth saying. Hey, we may need to adjust the allocations to go ahead and infuse more global, non-U.S., international, however you divide up those terms amongst your own firms. This is a pretty good opportunity. Back to you, JG.
Yeah, and certainly in the number of groups and emerging markets and the likes have certainly been leading that charge on the non-U.S. side. You mentioned areas, while there are a lot of things that are working, there certainly are some areas that have not been working, and probably one of the biggest areas recently out there that has not been working or has not been in our favor is the trend of the U.S. dollar. And the U.S. dollar has now entered what we would consider to be a falling dollar environment. And that's just basically defined as a move of 10% down for the U.S. dollar. And that's what we've seen from a peak back in March to a recent low down here. As a matter of fact, the recent movement over the course of the past week in the dollar has taken out that support from June, July, August, September of 2018, moving down to 93, taking out that support. And so, it's always interesting to look out at this. And there's ways to directly take advantage of a down bearish dollar or negative trend in the U.S. dollar through something like an Invesco bearish dollar ETF, symbol is UDN. And that ETF is a bearish dollar fund. So as the dollar falls, the price of UDN will go up. So for those looking to kind of directly take advantage of that, again, just in terms of how does it get exposure, that fund is going to get exposure through futures contracts. So there's the K1 piece of that. So just be aware. But that's one way to certainly take advantage of a bearish dollar. But what we've seen over the years is there's some very important trends that persist in falling dollar environments, as well as rising dollar environments. And one of those trends in falling dollar environments that we've observed over the years is that non-U.S. equities do much better than they do in rising dollar environments. It doesn't mean that U.S. equities necessarily does bad. As a matter of fact, if you split the rising in dollar time periods for U.S. equities, the returns are almost identical during those time periods. So it's not saying that U.S. markets can't do well, but historically what we've seen is that non-U.S. equities do much better in falling dollar environments than they do in rising dollar environments. Additionally, commodities, gold, international currencies, those are all other areas that do much better during falling dollar environments as well. So, those are just some trends that we've seen over the years. And we define those environments by, anytime that the US dollar fell 10%, that kind of started, that was the falling dollar piece. And these things don't turn quickly. On average, going back to 85, these falling dollar environments have lasted for over 500 days on average. And so, you're talking a year and a half or so that these trends can last. And, right now we've been in a falling dollar environment for basically the past 4 months since the March peak. So if we drilled into that a little bit more and kind of put some numbers on it, we can see here that, on the left-hand side, emerging markets, the red bars represent average returns during falling dollar environments. The green bars are average returns during rising dollar environments. And we can see emerging markets just perform much better, relatively speaking, during falling dollar environments, as does the IFA, so international equities. Crude historically does very well as gold during falling dollar environments. And equity markets, you look at growth-oriented stuff tends to do better during rising dollar environments, but still absolute returns are still up there in terms of the S&P 500. The average returns during rising and falling dollar environments are almost identical at 15% apiece. So those are just some trends that we have observed during these different time periods, and certainly what we have seen here recently too, in terms of your comments about international equities, Steve, the precious metals being among the most improved groups. And when you look underneath the surface, go back to the asset class group score page and look at all of the groups that we follow, all 135 groups, and you see what areas have improved the most in terms of which areas have the highest score direction. There's a lot of those themes that the international markets, the non-correlated commodities, alternative types of areas are all up there right at the top.
Yeah, and this is, we're looking at the score directional, page view on asset class group scores. We've used this actually several times over the last rolling month to, really to highlight the improvers. And JG is pretty interesting is that eight of the players, the investment groups on this view that you see here, 8 of those are non-U.S. and international related, which is no small number. It's pretty significant that we have that much improvement, widespread. I wanted to make the honorable mention among those 8 would be emerging markets diversified itself, which has now moved up to the 3rd best score directional group on the system, behind, I might add, 2 sector areas. Now, as you might recall, often sector areas have the ability to outperform macro, the more diversified groups, and so often you would see sectors leading, different market styles. It's kind of harder for a diversified group to always be at the top because the sectors can outshine, at least in the short run, or you could say, if no other time frame, temporarily. But what we see here as a macro group to be the 3rd most improved diversified group make it to the third most improved group on the system is pretty notable. And the emerging markets diversified is, scoring at 3.81. Now that is, I wouldn't say so close to 4, but it certainly looks like hitting a 4 score is very doable from here. Keep in mind that the emerging markets have been nowhere near 4, the score 4 for several years. In fact, the last time that the emerging markets group punched up above the score of 4 puts us back to 2017 in May, as I recall. And that led to a good trade there, and it wasn't long lived because the whole global scene went through some bearish action, as we moved into 2018 and 2019, and of course lately in 2020. So, but I do think it's a good opportunity to keep in mind that emerging markets is vastly improving, probably going to move a score above the score of 4. Keep in mind when I talk about a group about averaging, keep in mind that there are many players underneath any group that are far superior to its own group average. To say it another way, is that the average emerging market diversified fund is scoring at 3.81. However, there would be many emerging market opportunity funds, that you would look at, whether open-end mutual fund or ETF, that would score significantly higher than that average. And those are the opportunities that are in your inventory. You're taking a look. You're looking at the evidence. You're saying, hey, how do I increase exposure to non-U.S. in general? And then, of course, as we pointed out, the emerging market style versus developed market style is clearly in the better leadership. So that points to, how do you add some non-U.S. to the allocation? And more than likely that could be emerging market driven. So that gives you kind of a game plan, now that we're in the middle of the seasonal quarters of the summer, to say, hey, we still have, we've been hearing it for weeks now, but we still have an opportunity for non-U.S., beefing up non-U.S. allocations, and of course, good target material of who those individuals would be, emerging market related. So I think it gives you a good game plan, to stick with, those opportunities as being more new. More available to say, hey, that's something I can start to talk to clients about, and continue to raise, those investment allocations, and continue to follow that harmony that the market is telling us to, get involved with. Back to you, JT.
Yeah, Steve, it's great insight, and I know later this week, it's being a move into seasonal quarter. There are a number of the FSM models that are set to evaluate, and likely seeing a number of changes coming through those models. One model here, just as the turn of the month came, is a change in the FSM model, the American Funds 5M model, which is a monthly evaluation, not a quarterly evaluation. And so the change here recently that we saw, Steve, earlier, was a pretty interesting change with new perspective coming into the model.
Yeah, it certainly is. And for all of us, on the call here, we know that American Funds is an over-diversified shop. I say that in a good way. They don't spike on little sectors that move around. They're looking for broad themes, and they do well tracking along with those big thematics. And what you can see here, I think, are two things. It may be non-obvious, but American Funds, the monthly model, was running at a 60-40 equity to fixed income mix all through this distressed period of time until last night, where we got rid of a mortgage-based fixed income fund from American Funds, a great fund, and replaced it with the new perspective. Now, let me go with step one. So what that did is take a 60-40 portfolio back up to 80-20 equity fixed income in that one move. So that strategic allocation, that dynamic strategic allocation, did move in favor of equity versus fixed income on this update, simply by changing one pair of funds here. And so that gives you an idea of how the FSM models, will work with, that kind of strategic theme, adjustments, as the quarters go by, and in this case, as the months go by. And the other thing to keep in mind is which fund did replace the fixed income? Well, it was New Perspective. Well, New Perspective is known as a classic global fund. Generally 60-40, 55 or so, and then 50-50 with that U.S. and then non-U.S. mix. And that's why it's always classified as a global fund, because of that keen interest by American funds to make sure that there's a mixture of that international and global feel under this fund. And to me, I would call it the most popular and most well-known global fund. But for others that don't know that, we can keep in mind that this is very much a global fund by nature. And I think it's interesting that that's the fund that came in to join Small World. Keep in mind, Small World's been in the portfolio. That is small cap US plus, small cap international, been in there, and now joined by another large cap player, as in New Perspective is always large cap in nature, with this theme of US and global, which implies international moving into the scene here. So you've got some good good things happening with the allocation mix, punching up a little bit more of the equity position, and again, punching up, I think, more significantly, this global and international flavor. And I think that's important to note, keeping on track with the changes of American Funds Monthly. Some of our most popular models will update this week. Many of them are slated for tonight, which means when you come in Tuesday, you'll be able to go through the changes in American funds. You'll be able to go through the changes in T. Rowe Price. You'll be able to go through the changes in, FSM, U.S. Core, and All Cap World, and there are many others. The Tortoise and the Hare is another model. It's a master model of all the submodels. But the idea is that I think this week's important, because that's when you log in and say, hey, do I have the allocation that's in harmony with the market? What changes are being made in these models? What changes do I need to inform my clients about? Because any of those changes can change the allocation, the harmony of the allocation on the equity fixed income frontier. And of course, any of those changes could change the flavor of equity from U.S. only to U.S. plus some non-U.S. And different models will approach it maybe differently. But I do think it gives you a great time to reach out to the client and say, hey, we've got some new news. We've got some things to do. This is an action-oriented summer. I think everyone knows that intrinsically, but it's good to say, hey, we've got some things to do. Let's pick up the phone, make those calls, let people know how we're doing. As we continue to move through, this market type, as we continue to move, into deeper parts of the summer. Of course, we're all heading for November, which we would assume will be a very popular month to watch as well. But that's how this works. The technical edge is where we have activity, we have scheduled activity. We let our clients know what is going on, and that makes them feel like someone's minding the shop. And that's exactly what's going on here. So, definitely stay tuned this week. Log in. You can call Dorsey Wright with questions you may have, but I think it's a pretty exciting time. And of course, American Funds leads it off a little bit here with a little bit of a foretaste. There might be some allocation changes that are definitely worth looking at and getting excited about and going on from here. Back to you, JG.
Yeah, Steve. So in terms of model updates, it's a big week this week. Also, turn of the calendar to a new month. There's always a lot of models that get updated on our website at the end of the month, and then as we're entering the seasonal quarter. So if you're logged into the website, you go to the models page. One way to see which models have changed is on the far right-hand side there. If you see the blue bubble, the blue kind of oval there that has a number in it. For instance, one of the stock models that is a monthly evaluation is a large cap core stock model, which looks at an inventory of the top 500 market cap stocks. And it's designed to own about 30 names out of the top 500 market cap. So there were 4 changes that happened as a result of the monthly evaluation. 2 stocks went out and 2 stocks came in, but that's what that bubble means there. You'll also notice a little bell icon next to each model. If you want to be notified or sent an alert if a model changes, click on that bell icon and it'll turn it blue. Any models that you see the blue bell icon, you are set up to receive alerts on those models. So whether it's FSM models, whether it's stock models, ETFs models, any model that's on there on the platform, you have the ability to set those alerts on there. So I encourage you to do that, especially for those models that you're following or at least monitoring to see any of those kinds of changes. But like Steve said, if you have any questions, please don't hesitate to give us a call. Our number 804-320-8511, or please email us dwa@dorseyright.com with any questions, comments, concerns, or just general discussion points on the market or individual positions that you may have or may be considering for a client. So with that said, thank you for joining us. Again, we really appreciate you taking time out of your day to join us for these calls in terms of what's going on with the market. If there's anything that we can do to help you and your business, please let us know. With that said, thank you for joining us and look forward to talking to you next week.